Good evening everyone and welcome. Thanks for joining us tonight for our inaugural webinar on property investing in 2016, Where are the Opportunities? My name is Rich Harvey, Managing Director of propertybuyer.com.au. We are independent buyers agents and property advisors. I have with me tonight a very special guest, Terry Ryder from hotspotting.com. Terry has been a specialist researcher, writer on residential property for over 32 years and has published 4 books. In 2006, he created hotspotting.com.au, which helps investors find the best places to buy around Australia. He's a regular media commentator on television, radio and print, and a fantastic real estate writer. Welcome to you, Terry.
Hello, Rich. Good evening. How are you going?
Very well. Great to have you on board.
Yeah.
So tonight, everybody, during the webinar, you'll have the opportunity to ask any questions you like, and we'll attempt to answer as many of those questions as possible at the end of the presentation. All you need to do is just type your questions into the box on the screen and hit send, and we certainly welcome your interaction. Also during the night, we're going to have a special offer for a free strategy chat with myself to help get your property investment goals on track. So just a quick overview, everybody, for what's happening tonight. Firstly, Terry's going to look at the broader market conditions and give us the real perspective on what is happening in the property market. Then he's going to drill down into the finer details, which I'm sure you want to find out about areas that have excellent potential for investing. We're then going to both look at some classic mistakes that we see investors make before we move on to look at specific strategies that you can use in today's market to generate the best returns. And we'll also look at a couple of live case studies before we open up for that Q&A session. But first, Terry, I'd like to give you the opportunity to give us your fantastic perspective on what's happening in our changing property market. Thanks, Terry.
Okay, Rich, thanks very much. Yes, very pertinent to ask the question, where are the opportunities in 2016, because I think we're at kind of a pivotal moment in the real estate cycle in Australia. I think things are starting to change. In simple terms, we've been through a period of 2 to 3 years with a very strong market, obviously in Sydney, an elevated market to a lesser degree in Melbourne, and then across the rest of Australia, strangely muted markets in most of the other major cities, and some of them actually going backwards with their prices, and a very similar scenario in regional Australia as well. But things are starting to change, and I thought to set the background, we'd first have a look at some of the key indicators of some of the national indicators of real estate. On the screen we have figures for home loans and investor loans. Now if we had the same slide up about 3 months ago, they would have been very different numbers. The most recent figures show that home loans are actually growing faster than investor loans now, but 3 months ago and prior to that, it was very much the opposite. There was very, very strong growth in investor loans, much more so than home loans, but that's changed. Partly that's because the Sydney market has started to come off the boil. There's less investor activity there, but also the measures by APRA, which have flown through to the different policies and the major lenders, starting to diffuse the growth in investor loans.
Just on that, Terry, do you think that the APRA rules have had a dramatic effect and the right effect, or do you think it's too little too late?
Well, I actually think it's they didn't need to actually do anything, and it is a case of too little too late. The main issue was not a national issue, it was a Sydney issue. Sydney had already started a gradual fade, according to our numbers, right from the start of this year, so APRA didn't really need to take action. What it's in effect done is it's punished all of Australia, investors right across Australia, to try and solve the Sydney problem. If they were going to do something, they should have done it a couple of years ago.
Exactly.
But anyway, for various reasons, we've now seen a slight rebalance in the breakdown between owner-occupier and investors. Previously, it was about 58% of loans going to owner-occupiers, 42% investors. Now it's more 62% to 38%. So we're starting to get back to what we might term a more normal market. We have still have strong rises in building approvals, but the great bulk of that is coming from approvals of units, which in some cases is indicative of developers building too many units in some of our major inner city markets. The Australian Bureau of Statistics property price indexes up to the end of June illustrate the point that very much it's been a Sydney story, and other cities have shown very little growth. More recent data that's now starting to come out from some of the other research sources shows that Melbourne's price growth is now elevated, but those other cities are still very muted, in the case of Perth and Darwin going a little bit backwards. In the apartment markets, that's even more stark. Strong growth in Sydney, not very much growth in Melbourne, Hobart and Brisbane, and those other markets, prices, median apartment prices going backwards. And in most cases, I believe those figures are indicative of emerging levels of oversupply, particularly in the inner city apartment markets. Very strange lack of rental growth in most of our markets, and again, Darwin and Perth, the two cities where markets are going backwards at the moment, you can see quite significant drops in median rentals, both for houses and apartments in those markets. But an absence of strong rental growth in the last 12 months in all markets, with the exception of Hobart, where there's been 6 or 7% rises, according to those figures from Domain. As we all know, interest rate levels are at record lows. They've actually been that way for something like 4 years now, very low levels of interest rates. The last decline was in May. Affordability outside of Sydney is actually quite contrary to the general media rhetoric. Affordability levels are quite strong around Australia. Sydney is an exception, of course, because of the very, very strong price growth we've seen there over the last 3 months. Another bit of media misreporting keeps telling us how first home buyers are being priced out of the market, and that the great Australian dream is dead. Well, the research shows quite the opposite. There's still a very, very high level of activity from first home buyers around Australia. According to the NAB survey, about 25% of all sales consistently at the moment are to first home buyers. Another media myth is that there's a lot of mortgage stress out there, but again, the independent research shows that mortgage delinquencies, that's people who are behind on their repayments, are very, very low levels. And other research shows that almost 3/4 of households who have mortgages are actually ahead of their loan repayments. In fact, the average situation of a household is about 2 years ahead of their loan repayments. So from where I sit, that's a very, very comfortable level of debt management in terms of the housing market around Australia.
And I think just on that, Terry, I think it's a really good point to make, because I think a lot of investors mistakenly look at what happened in the US when the subprime crisis hit, and prices were rising rapidly, and then they had a massive crash. That's very, very unlikely, almost impossible to happen here in Australia, because we have a very robust financial situation. As you've pointed out, people are ahead on their repayments. There's a lot of equity in properties, so it's more just a very much a case of moderating growth going forward. Would you agree?
Yeah, I think the decline in the United States market happened for a set of clear reasons, and none of those conditions actually exist in Australia.
No.
And the point you make is very valid, and that is that the regulation of lending in Australia and the regulation of the property market by APRA, the Reserve Bank and other authorities is very, very strong and stringent. It can be a pain in the butt for people who operate in the industries sometimes, particularly the recent APRA measures, but what it does mean is it does make sure that our markets stay stable, and the possibility of significant decline is reduced to almost zero because of that. A very pertinent question to ask at the moment is, why has it only been Sydney that's had this, what I would call a genuine property boom? Melbourne's been a little bit elevated. The more recent figures show that it's rising, but really it's been a Sydney story. And it's pertinent to ask the question because almost every day in the media there'll be a commentator or a journalist, usually an economist, saying, well, it's all because we've got these record low interest rates. And of course, that's not a valid explanation, because we've had record low interest rates right around Australia, but it's only really been Sydney amongst the major cities that has had that very strong property boom. So there's obviously another explanation for why Sydney has done what it's done, and I think it really relates to what's happened in the New South Wales state economy, the level of infrastructure spending, and also the standard of governance at a state government level. There was a change of government about 4 years ago, and things started to turn around for New South Wales and Sydney after that. 3 years ago, New South Wales ranked second last amongst the economies of Australia, and now it's a very clear number one. And by some considerable distance, New South Wales is the one economy in Australia that's really pumping at the moment, and that's flowed through to the property market in Sydney, I believe. We've also had an elevated level of infrastructure spending, tens and tens of billions of dollars being spent on motorways, rail links, hospitals and other forms of infrastructure, and that has a big impact in generating economic growth and business confidence, and property markets respond to that. We've also had an absence of oversupply. I think it's also relevant that in the preceding 10 years the Sydney market did very little, and so it's playing to a certain degree catch up, boosted by strong governance, a very strong state economy and elevated levels of infrastructure spending. So I really believe that that's what's been behind the last 3 years of growth in the Sydney market, and very little to do with the level of interest rates. Now if we look ahead to what we expect to happen in this new financial year 2015-2016, I thought just a quick armchair snapshot of the major cities. I think it's pretty clear. I imagine, Rich, that you would agree, as someone at the coalface in Sydney, that Sydney is past its peak. It doesn't mean we're going to see dramatic decline, but after 3 strong years, you would expect that Sydney's run would start to fade a little bit.
Yeah, look, its rate of growth, Terry, has to slow. I mean, like you've just mentioned, it has been a lot of catch-up growth. I mean, during the years since the last boom in 2003 to about 2011, it was fairly moderate growth. Obviously, we had the GFC thrown in there, but it rebounded very strongly from that. But nothing spectacular growth-wise. The last 2.5 years have been quite spectacular. Like a 21%, and I can't remember the exact numbers off the top of my head, but very strong growth, and that's not sustainable going forward. But we do see further growth in, I think, next year. I think SQM numbers are suggesting that Sydney's still going to grow somewhere between 5 and 7%.
Yeah.
And again, that it's underwritten by exactly what you're saying, infrastructure. The amount of projects going on, it's fantastic. When you drive around Sydney, see the number of road, rail, hospitals. There's a hospital going up the road from where I live. The M5 extension. There's so many roadworks and rail projects going on. That generates jobs. Badgerys Creek. I mean, you'll talk about these later, but all of those are still, we've got a very dynamic and moving forward economy. So it's not an area that you can say is going to be fading away anytime soon.
No, that's right. I think the overwhelming weight of commentary that I've been seeing in media in the last couple of weeks has been that we're not going to see any significant price decline, but we are going to see a moderation of the level of growth, and I certainly agree with that. Melbourne is still rising, and the numbers are coming through very strongly in Melbourne. Perth and Darwin are the 2 markets that were perhaps most affected by the defusing of the resources boom. That's thrown through to the capital city property markets, and they're both on a downward phase, heading towards bottom or close to bottom. Canberra, for its own local reasons, seems to be kind of stuck in neutral, sort of either going forward or back fast, largely I think because of the downsizing of the public sector, which has reduced demand and confidence in the Canberra market. The 3 cities where there appears to be plenty of upside with rising activity and potential for future growth going forward are Brisbane, Adelaide and Hobart. Both those markets in various ways are improving, but the strongest of them would be Brisbane, which we'll talk about in a little while. We have been charting the Sydney market for a long time, and we've noticed in our price predict index that the number of growth suburbs in Sydney has been reducing since the start of the year. These are suburbs which have rising numbers of housing and apartment sales. Still plenty of steady markets in Sydney, but the number of growth markets has been reducing as we've gone throughout 2015. We're now got a point where there's actually more growth suburbs in regional New South Wales, according to our measure, than there are in Sydney. But there's still activity, still growth markets in Sydney, and a lot of them now are out on the fringes, places like in the cities of Penrith in the west, Camden and Campbelltown in the southwest. But for an investor, in my mind, there's no doubt the best time to buy was 2-3 years ago. That's not to say there's not still opportunities, and we'll talk about where those opportunities lie. I think it's very much a case of following the infrastructure trail now that we've had those 2 or 3 years of strong price growth. We're going to find opportunities to get further growth in the short term and in the medium term in Sydney. I think it's a case of following the infrastructure. As you said earlier, Rich, there's just an amazing level of activity right across the Sydney metropolitan area of construction of motorways and railways and hospitals. There was a recent announcement of a major expansion of medical facilities at Westmead, which is a real centre of medical and educational facilities. It's a market we like a lot. Then you've got all the associated infrastructure that are going to start springing up around the proposed Badgerys Creek Airport. There's a lot of new motorway and road infrastructure proposed for that general region and also down in the southwest. We've got the northwest rail link under construction. We've got further extensions to rail links in the southwest. And so all of that points me to areas such as the municipalities of Liverpool, Blacktown, Penrith, Campbelltown, also Camden, those areas in the west and southwest that are going to be the major beneficiaries of that massive infrastructure spend as we go forward. There's going to be opportunities to pinpoint good places to buy in the Sydney metropolitan area by following that infrastructure trail. Also outside of Sydney, there are a number of regional centres that are being strong also at various stages of the cycle. Some of these are places that have caught away from Sydney, but they also have their own local reasons to grow. They include Wollongong. The Southern Highlands has come very strong with sales activity. Recently, Goulburn, also Dubbo, out in the west is a very strong regional centre. The Central Coast, places like Gosford and Wyong have had very elevated markets. And Newcastle is also a standout, very much, I think, an underrated city. But if you take Newcastle and the Hunter region together, I regard them as one of Australia's strongest regional economies. A very important export port, a lot of economic diversity. It's not just about the coal industry, which currently is in a bit of a down phase, but that Hunter region has very strong wine industry, very strong horse breeding industry, strong tourism, manufacturing, lots of diversity there. And we're, after going through a period of oversupply, those markets are now starting to recover, and Newcastle is actually looking as a very strong market, as perhaps an affordable alternative to Sydney. It's got very strong transport links to Sydney. There's strong spending on infrastructure, and in particular, I mentioned the RAF base and airport just outside of Newcastle, where there's massive spending coming up. Just one of many factors driving the economy there.
What's interesting, Terry, about Newcastle too is that I know a lot of people, just actually personal friends, that are also moving there just for lifestyle choice. Like, they want to get out of the rat race of Sydney, but they still want to be within 2 hours of it, hour and a half of Sydney. And Newcastle's got some beautiful beaches. It's got some lovely amenity, great schools, beautiful waterways around Lake Macquarie. So there's a great lifestyle appeal for virtually half the price of what you're paying in Sydney.
That's right. I mean, it is a really great, affordable lifestyle proposition. The beaches in Newcastle, and then outside of Newcastle in the area around Port Stephens, and then going inland to the wine growing areas and the horse breeding areas, the Hunter Valley. And
exactly.
It's just so many wonderful choices.
And
there.
that Hunter Valley Expressway has cut the commuting distance. People that live in the lower Hunter can commute to Newcastle and cut about 20 minutes off their trip now. So I would caution about investors going to the upper Hunter though. The areas that are still more mining based, like Cessnock, Singleton, I'd caution there. But the lower Hunter, around Cessnock, Maitland, definitely still worthwhile considering.
Yeah. A particular warning at the moment on Muswellbrook, which has been a strong market in the past, but developers, as they so often do, piled in there and built too much new stock at a time when the coal mining sector was going into decline, and that's caused a big oversupply. It's improving, but right now it's a market to stay out of.
That's right.
But Newcastle itself, looking pretty strong. People just need to keep an eye on vacancy levels in the downtown areas where there's a lot of new apartment construction in the pipeline. Just keep an eye on that. But as an overall city, Newcastle is a good, strong market to consider. Looking further afield, we see strong momentum in Melbourne still, lots of growth suburbs there, and that's starting to come through in stronger price growth data from most of the major sources now. Brisbane, still very active. Adelaide starting to rise, and some of the regional markets, particularly regional Queensland and regional New South Wales, looking plenty of growth markets there. Southeast Queensland, in our view, is the number one rising market in Australia. If you take the Gold Coast, Brisbane and Sunshine Coast together, is one big urban conurbation stretching from the New South Wales border right up to Noosa at the north of the Sunshine Coast. Elevated activity right throughout in terms of sales, more growth markets than Sydney now, more rent markets than Melbourne. We're certainly very cautious about the Gold Coast, but the Brisbane metropolitan area and the Sunshine Coast we think are very strong prospects. Looking at the Brisbane metropolitan area and where we're seeing the most activity, 12 months ago we would have said Brisbane North Side is where most of the activity is, but it's switched around to the south now. So Brisbane City Council area, the south side suburbs, those middle ring suburbs of Brisbane City, very strong activity there, property selling very quickly, and equal first with them is Logan City further to the south. Logan City is the municipality that bridges the gap between Brisbane City and the Gold Coast. Lots of affordable suburbs there, great transport infrastructure, both road and rail, lots of shopping propositions, plenty of schools. Just for people on a budget, both as investors and home buyers, Logan City is a great place to consider. While the generalised data, the research houses tend to publish a single figure for each city in terms of price growth. It's 15% for Sydney, and of course behind those figures there are a multitude of sub-markets all doing different things. And that's certainly the case in Brisbane. That the centralised growth figure for Brisbane is often around 3 or 4% at the moment, and it gives the impression that there's not a lot of growth happening in Brisbane. When you dig a little bit deeper, Rich, you find that there are sub-markets where there's double-digit growth going on. Some of the north side suburbs that I mentioned earlier have had growth of 13, 14, 15, 16% in the last 12 months in their median house prices, and we're starting to see that sort of growth merging in some of those south side suburbs I mentioned as well. So behind that generalised figure, there are pockets of much stronger growth, and Rich, I think as a buyer's agent that's very active in that Brisbane market, you're probably finding that as well.
Yeah, I think it's really important that some median prices and some statistics about areas really hide the specific suburbs. Like obviously Logan's an area we're very active in, as in Brisbane North as well, and Ipswich. But there's certain pockets there you would buy and certain pockets you wouldn't buy, and it's sort of knowing the numbers and knowing the details on the ground that helps us get the best result and the best long-term result for our clients.
Yeah, I think that the message there for investors, you've got to dig a little bit deeper in your research and not just look at those generalised figures that the economists tend to put out, which can be very misleading. Just briefly touch on the Sunshine Coast. It's a strong coming market, a transition economy. In the past it's suffered because it's just been about tourism primarily, and that's a very fragile, volatile economic sector. But Sunshine Coast City economy is evolving with new strands coming in, particularly the spend on medical facilities, a $2 billion hospital, which is inspiring lots of other development. And so that's a market to watch, very much a growth market. As I mentioned earlier, we're very cautious about the Gold Coast, even though right now it's a rising market. It's spent 5 years absorbing the previous oversupply of high-rise apartments. Values are still lower than they were 5 years ago. In some cases, the high-rise suburbs values are lower than they were 10 years ago. It's now starting to come strong again. It's going to have a lot of publicity, a lot of PR about the Commonwealth Games and Chinese investment. Urge people to be very cautious because there's a massive levels of new construction happening in that market, and you feel it's going to go through the same boom-bust scenario again. Just quickly, Surfers Paradise price growth rate for apartments, further drop in the last 12 months. It's been declining for the last 3 years, the last 5 years, and indeed the last 10 years. What that means is if you bought the average Surfers Paradise apartment 10 years ago, today it'd be worth less than you paid a decade ago. That's the sort of result the Gold Coast produces, and we do urge people to be very, very cautious about getting enticed by the propaganda machine that's starting to emerge again from the Gold Coast. Adelaide is worth a little bit of focus. It's very much an underrated city. It's a great value proposition because its prices are much lower than cities like Melbourne and Sydney. It's got rising momentum, lots of character housing, quite strong rental yields relative to Melbourne and Sydney, and big spending on infrastructure. In a similar vein, Hobart starting to stir at last after being dormant for a long time. Tasmania's been the basket case economy of Australia for a long time, but it's actually starting to improve. There's economic growth happening, there's investment happening, there's confidence rising, and we're starting to see the Hobart and Launceston market starting to respond to that. I think it's very important for investors to not just focus on the capital cities, particularly if you're on a budget and you're looking for something you can afford, and perhaps better rental yields than you can get in Sydney and Melbourne at the moment. If you buy in the right locations, you can actually achieve what we call a win-win-win situation, cheaper prices, better rental yields, and strong prospects for capital growth if you choose the right regional centres. Obviously, there's a lot of country towns, resources affected locations out there which are not strong property markets. They're the ones to avoid, but if you choose the right ones, good strong regional centres with a substantial population, a diverse economy, they're good prospects for people to buy affordably and get good rental returns and some capital growth in the future. And here are some of the places that around Australia that we rate: in Victoria, Bendigo, Ballarat, Geelong, all have good prospects for the future. There's some over in Western Australia, particularly south of Perth. We certainly avoid the resources regional centres like Port Hedland and Karratha, but those more lifestyle locations south of Perth are good prospects. Lots of growth markets in New South Wales. As I said earlier, partly, Rich, it's because these places have caught the wave from Sydney, but they all have their own local reasons to grow. Newcastle, we talked about. Dubbo's got wonderful local economy, growing population, and some of those other places on screen also stand out as places that are worthy of consideration.
Absolutely.
And in Queensland, the Sunshine Coast, I mentioned Cairns is, for similar reasons to the Sunshine Coast, a transition from being just a tourism economy with lots of spending on infrastructure. Townsville, a very strong city, coming strong again. Rockhampton, Hervey Bay, and Toowoomba are all places with prospects, and I'd like to focus just a little bit on Toowoomba because it's such a strong region. It's a very good example of what I'm talking about as the sort of regional property market that investors could consider. It's a growing centre, it's got a substantial population. One of its most important things is the diversity of its economy. We always preach this to people that you don't want to buy in places where it's dependent on just the tourism industry or just the mining industry, because that has a high level of risk. Toowoomba has lots of different elements to its economy, including manufacturing and agriculture. There's lots of infrastructure spending being directed there because increasingly it's being seen as a very important and strategic city. There's a $2 billion bypass motorway project coming up shortly. There's been a new airport built there recently. It's getting a lot of spin-off from the coal seam gas industry that's happening out in the Surat Basin to the west and northwest of Toowoomba. It's got lots of affordable property, lots of suburbs with median house prices still in the 200,000s. It's had a couple of years of strong price growth, but taking a long-term view, we see it as a very good long-term proposition. I think it's a market, Rich, that you know a little bit about as well.
Yeah, look, we've had quite a few investors do really well out of that market. It's obviously got strong population growth. It's just 90 minutes west of Brisbane. Really attractive area to live in. There's actually quite a few wealthy people that live there. The airport was privately funded, which is quite amazing, and there's direct flights to Sydney every day now. So having that link with the flights is certainly bringing in more businessmen, which is really good. But you're really real strategically placed, and as you mentioned, that the bypass is having a very strong impact. But your good rental demand is one of those areas where you get a win-win, where you get both strong capital growth and strong rental income. The rate of capital growth won't be as high as it's been in the past, but still very strong. So I think investors anywhere need to be a bit more moderate in their expectations. But you want to pick an area that's safe. That's definitely one that we'd recommend.
Yeah, totally agree with that. It has had a couple of years of strong growth, so it's probably not going to have that same level in the near future, but it is a good, strong, long-term proposition. And the reason for the illustration on the screen, it's part of its tourism appeal, very strong tourism city, Toowoomba. It's renowned for its parks and gardens, and particularly for its annual carnival of flowers. So yeah, lots of prospects there. Now I want to turn to some of the mistakes investors typically make, and I come up against this, Rich, all the time. We get emails every day.
Terry, this is the reason, I just want to interrupt you there. This is the reason I wanted to ask you this tonight, is because you obviously feel a lot of phone calls from investors going, where do I buy, or I've made a bad choice, how do I get out of it? And I think if one thing we can do tonight is to educate investors not to get into a bad investment, then we've certainly achieved part of our objective. And I've seen a lot of investors come to us after making a shocking purchase, and it's going to take them years to get out of their investment. So we'd love to hear just what your thoughts are, and then I'll follow with some of my thoughts about what investors make too.
Absolutely. I mean, I can't believe some of the decisions some people make. Sometimes I get emails from people, they've got a portfolio of 3 properties and they're all in the one location, and that one location happens to be Gladstone in Queensland, which is a market going sharply backwards, or a coal mining town like Moranbah, and you wonder why did they make that decision. I think there's too many people use these what I've euphemistically called investment strategies. They make their decisions from the herd mentality. They read that there's a boom on, so they want to follow the herd. A lot of people like the comfort of the herd, so that they follow the pack into a boom market, which means they're buying when prices are high. And let me tell you that nobody ever got wealthy following the herd. The truly successful people either lead the herd or they actually detach from the herd and move in the opposite direction. So it's the people who actually buy real estate when markets are down rather than when they're booming are the ones that do the best. We also refer to what we call the FOMO syndrome. FOMO stands for fear of missing out. And of course, we've seen a lot of people piling into the Sydney market, hearing about the boom, don't want to miss all that wonderful capital growth, so they dive in. Again, the intelligent investors, the ones that are switched on and doing their research, will be buying ahead of all of that. Smart people would have bought 3 years ago in Sydney. Perhaps intelligent investors might be looking at Perth right now because that market is down, but we know it's got a very good track record. We know the Western Australian economy is traditionally very strong. It will be strong again, but buying now when the market is down is a good proposition to consider. And finally, I refer to the soundbite method, which is basically that people tune into small snippets of information from media. They absorb headlines, they absorb sound bites from electronic media and think that that's information. They think it's research, and of course a lot of it's misinformation. It's propaganda from people, and they're filling their heads full of misinformation. And if they base their investment decisions on that kind of stuff, they're going to be making bad decisions. So I think the message is people have to be better than that. They've got to do genuine research. Sadly, the research indicates that most people getting into property investment actually have a bad experience, and I think that they tend to fail because they fail to prepare. They go into property investment without a clearly defined goal, without clear strategies for getting there. They just have this vague notion that they should be doing it because others are doing it. They perhaps need to provide for their retirement. I should buy an investment property. So they start looking for properties to buy without first actually sitting down and making a plan, looking at what their objectives are and how they're going to get there. And the most important thing they have to do is to actually be willing to spend some time and some money on research and accessing quality advice, because most people don't. I think most people have a bad experience because they dive in, they try to save money by doing it all themselves, and they go about it badly. The successful people are those who are willing to actually spend time and money on quality research and quality advice, because there are some really good people out there who can help you, such as Rich Harvey from Property Buyer, help you find really good property in good growth locations rather than trying to do it yourself by going to realestate.com and looking for something to buy, which is what unfortunately too many people do. So this is the proposition that I constantly hear from people via email, by phone call, when I'm speaking at seminars around the country. The proposition in simple terms is, yeah, I'm willing to spend $500,000 to buy a property, but no, I won't spend $50 on a research report, and no, I'm not going to spend $500 on a valuation to make sure I'm buying at the right price. And I certainly not going to spend $5,000 accessing professional advice and assistance because, you know, I want to save money by not spending that money. And of course, experience shows that it's the worst kind of false economy if you aren't willing to spend some money accessing the very best advice. Developing a team around you of professional advisors are good in areas where you're not strong, so that you're going to make a good investment decision and you're going to benefit. You've got to spend money to make money, I think is the central message there. The fundamental difference, I think, between those who succeed and those who don't is research and quality advice and the willingness to pay for it. It really starts with researching yourself. I think you really have to understand what your goal is, and then you've got to have clear strategies for achieving those goals, because there's lots of different strategies in investment. There's no one right way to be a property investor, and the right way for you will be different to the right way for the person sitting next to you. So you need tactics for implementing your strategies. You've got to understand what your risk profile is, and a lot of people don't even know what that is. Are you comfortable with a high level of risk? Would you buy in a resources related area? Because a lot of people who have bought there in the past were very much unsuited to owning property in those places. They're absolutely panicking and not sleeping at night because those markets have declined. And having researched yourself, then you've got to start researching real estate markets and understanding. The most important thing is to understand the difference between information and misinformation, because newspapers are actually full of misinformation. Reading newspapers is not research. You've got to be better than that. You've got to go to good information sources and start collecting information on what's happening with prices, what the vacancy rates are. You've got to look at building approvals in an area to understand whether there might be a future level of oversupply in a market. So many things that you should be doing to be well researched to make good decisions. And finally, some questions that I think people could ask themselves to perhaps protect themselves, because quite often I get communications, Rich, from people who have fixated on a particular location. I often wonder, why of all the places in Australia, are you fixated on buying in this location? Somebody's told them something, they've read something. I think people need to ask themselves, why am I considering this investment? Whose information am I relying on? Who's paying the person who's giving me the advice? Because if someone's giving you advice and you're not giving them a fee, somebody's paying them. And quite often it's a developer who's got product to sell. And that's a very dangerous situation for an unsuspecting property investor. And finally, I think a very good question that people should ask themselves is this property I'm considering buying in this location that I like, is this the absolute best investment currently available to me in Australia right now? There's a very large country full of thousands and thousands of suburbs and towns. Is this the very best? And if the answer isn't a resolute yes, you need to keep looking and keep searching. Closing thought, Rich, the most successful investors I know are all willing to spend money on researching quality advice. I know people who've got 20, 25, 30 or more properties in their portfolio. They're all people who over the years have been willing to spend money to access the best research and the best advice, and that's why they've been successful.
Some great thoughts there, Terry. Thanks so much for that. And I just reiterate, one of the questions just I think 2 slides ago you asked is a very, very pertinent question is, who's paying the person giving me the advice? And I think that's one key question that any investor needs to ask, because I see a lot of unsuspecting investors buying their first or second property getting caught up in a spruiking scandal or spruiking scheme. They don't realise that there's $20,000 or $30,000 that's being paid as a commission there to the person promoting that particular property. And they're obviously very energetic, very keen to promote a particular property to you without looking at the broader market. So I'll just flick over onto my slides now, and you'll see there that the 7 most common mistakes that we see investors make, and this is after, we've purchased over 2,000 properties for our clients, so we get some pretty unique insights to to the way people make decisions. But inadequate research, totally endorse that as our number 1 mistake that people make, is they don't do enough research. I mean, there's also the other side to that, is they do too much research and they get paralysis of analysis, you know, and they kind of think that they never make a decision because there's always a better one out there. And at some point, you have to have enough information to make a clear decision to move forward. Another mistake we see is people just can't negotiate. They don't know how to negotiate with agents, or they get taken for a ride or walked over, and it's just poor negotiation can save them, it's cost them a lot of money. I think this number 3 is more for home buyers, is buying on emotion. I've seen a lot of home buyers get very frustrated, particularly in the Sydney market, where they might have been looking for over 12 months. You know, the market's moved 100 to 150 grand in their suburb and they're priced out, and they end up just buying something substandard that doesn't suit their needs. So you don't want to do that mistake. Another mistake is not understanding the cycles, and I think, Terry, you've covered off very well tonight on the different types of cycles that people need to understand. Buying for tax deductions. Yeah, I think if you want to buy a Gold Coast Southport apartment, that's really good for tax deductions, but very poor for growth. You know, tax deductions are the icing on the cake, in my view. They're not the reason you buy a property, but certainly can help you with your cash flow. Some people don't know how to crunch the numbers and have poor investment analysis. And another really big one, which I put right up there with research, is procrastination. People just putting it off for another day, or it's all too hard, and you know, the stars don't align. And look, there's never going to be an absolute perfect time in your life to buy a property, but we've found that the most successful investors and home buyers are ones that get their pre-approval in place, do the research, get the right team around them, have the right advisors, and make a decision to move forward. And that way, with all the facts, they can get a good result. Just before I dive into some of the key strategies that I want to share with you tonight and some case studies, I just want to explain very briefly how a buyer's agent works and what they can do for you. So first and foremost, a buyer's agent is someone that works exclusively for you. They're on your side. They're not there to sell you anything, and they get paid only by you as the client for impartial and independent advice. So they don't sell, they don't take sales commission, so they're very much on your side. The buyer's agent will do all of the research, all of the appraisal work, and they're your protection in that process, and they help you from making all those mistakes that we've just talked about. A buyer's agent will generally follow a 7-step process, which is outlined there. So firstly, they help you decide on a strategy and getting that right first. Then they do the research. They provide you with research reports like what Terry's provided, give you all the rationale for investing in an area. And then they jump on their bike and find individual properties that fit the strategy. I think a lot of people dive into step 3 without doing the first 2 steps, and they just jump on Real Estate and Domain and find, oh, there's a nice property, I'll buy that one, without considering does it fit their need. So once you've started searching, you then got to do a lot of work to find a short list of properties that fit, and then when you found the right one, we evaluate it, we appraise the value, we work out the pros and cons and check that it's worth the price that it's paid. We organise pest and building and contract review and other due diligence on the property. We then negotiate on behalf of the buyer and secure it for the best price we can and exchange it, and then we organise a local property manager to look after it and collect the rent. So that process, most investors probably take over 12 months to do that process on their own. We average around about 30 to 35 days for our investors from the time they've engaged us to the time we've found a suitable property. Obviously it can take longer than that, sometimes it can even be shorter if the right one pops up, but we're very efficient. We have a very good network of properties and agents to find the right opportunity. And I think that's one of the big benefits, is that we have access to a lot more properties than the average buyer. Because of our relationships with agents, we get a lot of off-market properties and pre-market listings. We do have relationships with some builders and developers, but we're extremely selective about who we work with, and it probably comprises less than 5% of our stock. Most of our stock is all established properties. And you see on the next slide, we've won a couple of awards for what we do along the way. We've actually won 27 awards for excellence in the last 15 years, so we're very proud of that achievement. And if you end up not using a buyer's agent, then you could end up like this. And no, that's actually a tourist attraction in China, that house. It's upside down. But just thought I'd put that in there for a laugh. What I'd like to do now, folks, is just really clarify a couple of ideas or a couple of strategies for you for ways in which you can improve your equity position and look to get positive cash flow properties. So Terry's given a fantastic outline on a number of different areas. So I'll just kick off briefly with Sydney. Look, the Sydney market, I believe, still holds quite a bit of promise. We don't believe it's going to go backward. In fact, we still believe it's going to go forward in 2016 with positive capital growth, but just at a much more moderate rate. and it's about picking the areas, if you've got the budget to buy in Sydney, about picking areas that have good potential for growth. So blue chip areas always work well. That's the northern beaches, eastern suburbs, inner west, north shore, or the northern suburbs. And look, in a lot of those areas, there is significant infrastructure. But to get into those areas, you're going to probably need to be for a two-bedder well above 750. If you're looking, say, in the sub 700 bracket, you can look in the southwest growth areas that we've talked about, Campbelltown, Camden, Blacktown, etc. Or in the western suburb areas, there's certainly a lot of opportunity. The areas that I'd stay away from is those areas where there's very intense development around, say, Zetland or the Ponds or Auburn, Hurstville, North Parramatta, where there's just thousands of units going into one very congested area. There's no differentiation in the type of property you buy, so I'd stay well away from those areas. But buying established properties with renovation potential, ability to add value or add a second dwelling, there's some that I'll definitely look at in the Sydney market, and they'll do quite well. I'll give you an example of one we did earlier. Actually, it was just the end of last year. Matt and our team bought for an expat investor. They had around $850 to spend on an apartment. They were focusing very much on the lower North Shore, more a good blue chip area. So we found them a property in Mossman. Now, this property had been on the market and it was overcooked. So they'd listed it with very high expectations for over $1 million. No buyers, it all fell through. Got listed with another agent. We picked it up for our investor for $820. We moved really quickly to exchange it and secured it, where our appraisal was up to $870. And what was the amazing thing was that in January, the agent rang my buyer's agent Matt and said, "Look, we know your buyer's paid $820, but we've actually got another buyer that's willing to pay $960 for it. Would he sell?" So we put it to our client, and they actually said, "No, we're just going to hang on to it." And they've obviously got fantastic equity in that property. So even in a hot market, you can still pick up relative bargains, is what that can show. And I know another buyer's agent friend of mine that spotted another two-bedder in Mossman on a busy road, but for about $750 the other day. So look, they do exist, and it's just a matter of being Johnny on the spot to pick them up. Another example in the southwest, we recently purchased a property very close in Narellan, very close to the town centre. It was a fantastic 4-bed, 2-bath, 2-car home on a 600 square metre block. This investor really wanted to get a foothold in the market. They had to go to the max of their budget. Their budget was only about $670, so she was able to use everything that she had to secure the property, and it was a very competitive buying situation. But we were able to negotiate this prior to auction, and it's got the ability to add value and potentially create a studio in the garage area out front. So it was a great buy, but again a very affordable one relative to the area that we're buying in. Terry's mentioned the Brisbane area, particularly the South Brisbane area of Logan, and we're very active in that area. We've purchased quite a large number of properties there. Stuart Fraser and my team's our specialist and has a very long track record of finding great properties. Majority he finds there are off-market through our relationships with agents. But as an example, this one we purchased earlier in the year for $295. So it just goes to show you don't need to have a massive budget to get into the property market. This was an established corner block, ability to potentially add a granny flat down the track, but it's currently renting just as it is for $370 a week. So very, very strong return, great potential for capital growth. And what we're buying in some of these areas is properties that have the ability to be rezoned. A lot of the areas in these Logan areas are going to be rezoned for high density for either townhouses or units. And I think I've got a slide coming up in a minute showing that. Another one we recently did just this month, similar price point, $325, getting a rent of $395. So these are basically positive cash flow properties you buy as is. You don't need to add value straight away. You can renovate them if you like and add further value, but we can find properties straight away for you that are going to generate a positive return based on today's interest rates. Again, really good sized block, room for a granny flat, but the position close to shops, schools and transport is what really made this one stand out for our clients. So really, really good opportunity there. In the next one, you can see the picture there of this next property. Not a highly attractive property. This was a property sourced off market in Logan, purchased for $450 just a couple of weeks ago, and rents for $400 a week. Now, obviously not a fabulous return, but the ability to buy this and amalgamate this potentially with the neighbouring property, which we're looking at trying to acquire, is going to give this investor the scope to get a DA for 14 units. So this investor can get a really decent return while they put a DA in, and then either develop the units themselves or on-sell that DA to another developer. So that's a super potential to add amazing equity to your portfolio doing that kind of strategy. Another one we're doing regularly for our clients, another example is in Newcastle, as we've talked about. We're doing a dual living style of property, so getting two incomes from the one property. These you can't buy as established properties. You have to buy this as buy the land and then build the property. But we're working with a really great builder that we've taken many years to find, and one we trust, who does the right thing by our clients, and quite a competitive build cost because we give them all our work. A 4-bed plus 2-bed dual living home, we got a package price of $624. But the amazing thing is the rental return in Newcastle was around $820 to $840 or $850 per week. So really strong yield, almost 7%, 6.8%. Now the build cost we've got includes everything: stone bench tops, timber flooring, air conditioning, landscaping, driveways, letterbox, the whole everything. So it's a turnkey investment. It is hard to find land where we can do this. We try to put it into areas that has a high percentage of owner occupiers, because then there's not as much competition with other renters in there. But we find small releases of land, go in there, try to secure them as quickly as we can. And what we've noticed is the land price has been ticking up quite strongly. So we bought this one earlier in the year, I think it was May or April, for $240. That same land today is probably worth about $270. So there's already an inbuilt capital growth at each stage that we're generally buying in these estates for our clients. So if you look at the floor plan for this type of dual living, you can see there on the screen it's got 2 beds on one side, al fresco, living and meals area. On the other side you've got 4 bedrooms. It's got a common party wall which is soundproof and fireproofed. So great ability to get 2 incomes out of the one property, and a very clever floor plan to maximise the use of the space. So good. You also get higher depreciation, double the depreciation you get on an ordinary property. So all round we think it's a win-win type of strategy to use. Another strategy, I don't always recommend it, but certainly in a rising market I would recommend it, and that's off-plan buying. So you have to be very careful when using this strategy. I've been quite successful myself in using it for buying a number of properties, but again, don't buy it in a declining or a market that's peaking. So parts of Melbourne and certainly parts of Sydney, I would not recommend it. We recently did one, earlier in the year we did one in Brisbane, about 5 to 6 k's from the CBD. We put a number of our clients into a really high quality development in Cannon Hill. The reason I put them into that area is that only 2% of the property stock in that market is apartments. So very low percentage of apartments in that area, high percentage of owner occupier. Great opportunity for downsizers to buy. If you're an investor and you bought one of these, you might hold it for 5 to 10 years and then you might sell it or flick it, and it'd be perfect for another investor or a downsizer. But really close to station, really large balconies, really good internal size. It ticked every box that we needed to tick. And as I said, we're very, very selective. Probably about 95% of the off-market stock we look at, we dismiss because it just doesn't stack up. But this one worked because of its price point, its access to the city, and its transport infrastructure nearby. Of those clients that bought in there, they were paying around $440 to $480 for a 2-bedder. The prices there have already increased about 40 to 50 grand, and so they've already got inbuilt equity when it settles early next year. Another one we did in Newcastle, we did an off-plan apartment block, but right in the centre of the city. I don't recommend off-plan and outer areas, but certainly close into the CBD. We were able to negotiate with the developer to get a discounted price. We were also able to get some rebates for the sales commission to the client. That's something to very emphasise here too. We don't take any sales com, we rebate any of that back to the client. So they end up getting a discounted price, plus several $1,000s back in their pocket at the end of completion. So again, these prices have risen quite substantially, as you see, between $370 to $385. They're now worth between $420 to $445. So quite a significant increase and a really good rental return. But again, really well positioned properties for the long term. Another one we've done is buying in the West Brisbane or the Ipswich area, 4-bed, 2-bath, 2-car homes for around about $330,000. The RAF base out at Leichhardt there has a new workforce of a lot of American workers coming in, and they're very keen to look to secure new properties to live in, so very high rental demand in that area. And again, we were able to pick up these blocks from a mortgagee sale where a developer had sold out and got into trouble, and we're able to get the blocks around 20 to 30k cheaper than others being sold in the local market. So again, just through our networks, we're able to pick up these kind of opportunities. Now, we mentioned, Terry mentioned Toowoomba before. One of the strategies we've been using there is a duplex strategy. So we've been able to get some really good quality blocks in there where we can get some equity uplift. So around about 570,000 is the total price for 2 lots of 3-bedroom duplexes. Now, on completion, they'll be worth about 310. Actually, they're probably worth a bit more today. They're probably worth about 330, but I'd like to be conservative. So I had a friend of mine buy one of these. They're going to make between around 50 to 60 grand in uplift, and again, really strong rental return, 350 per week each side. And as Terry said, there's not just one pillar in that Toowoomba economy. There's several pillars to it holding it up. So it's ideal for investors that want to create instant equity and also get some positive cash flow. So you've got the choice when you buy one of these to hang on to them both and enjoy the cash flow, sell them both and take the equity profit, or maybe sell one and pay down part of the loan. So it gives you a couple of exit strategies there. All right, so just a couple of thoughts before we open up for Q&A, and I just encourage you just to write any of your questions just in the box on the screen there and send it through, and we'll answer those in just a minute. But 3 lessons that I've learnt myself in my own investing journey and teaching many others the same things is that if you don't do anything, if you're apathetic and you procrastinate and you get that disease called paralysis of analysis, then you won't get anywhere. Secondly, if you rush ahead with no plan and no strategy, you're likely to buy in a bad area and lose money quite quickly. Or your third choice is to take action, positive action, but do it strategically and get the right team around you, and then you're going to see yourself making some steady wealth. So there's a couple of thoughts there. I'd really encourage you to if you would like to have a strategy chat with me, I do have a limited number of opportunities for that tonight. And if you'd like to fill in your details on the screen and send that through, my assistant will be in touch with you to set up a time, and love to have a chat with you about how we can progress your investment goals forward in 2016 and forward. But Terry, if you're there, we might just open up to a couple of questions if we can, and we'll see what's coming through. There's a question from Adam that's just come through, and Adam asks, Rich, I only have a pre-approval for 350k. Is that enough to get me into a good market? Or should I just sit on the sidelines and wait and see what happens? Or would you suggest now is a good time to buy? What are your thoughts on that question, Terry?
Look, I think people on a budget of that size still have lots of options. There are still options in capital cities, and there are options, plenty of options in good regional centres, such as some of the ones we've discussed. You touched on Toowoomba as did I. Newcastle is another good proposition where in that price range there are lots of options, and these are good strong markets that are going to show growth in the future and probably going to give you pretty good rental returns as well.
Yeah, I think my answer to that is 350 is still a good budget to get you into a market. I'd strongly think also that the Logan market's really good, where you can get both cash flow and potential growth going forward. Look, I think when there's negative media around, that's actually a really good time to be considering buying properties because there's less competition. It scares off the more uneducated investors and opens up the door for the savvy investors to make an opportunity. So again, I'd suggest buying when you have your pre-approval in place and when you've got the right research in front of you. That's a good time to buy.
Yeah, I don't see any reason why people should wait a while and see what happens. I think there's too many people out there who say, well, I'm going to wait and see what happens with interest rates, for example. I think it's just people making excuses to procrastinate rather than make a decision.
Yeah.
I think the bottom line is that I think the question that people ask, which is the wrong question, is this a good time to buy? I think the question they should be asking is, where is it a good time to buy? Because it's always a good time to buy somewhere in Australia right now. Markets are always on different cycles. It's not one big market. moving in the same direction. So there's always opportunities to buy well somewhere in Australia.
That's a great one, exactly right. Very good point, Terry. Another question we've got from Ahmed, and he asks, I've already got 3 properties in my portfolio in Sydney, but wondering if I should diversify. What are the prospects for Brisbane, and how can I buy interstate? What are your thoughts about the Brisbane market, Terry?
Yeah, I think the Brisbane's got very good prospects at the moment. The first part of this question asks about whether or not you should diversify. I think geographical diversification is really important. We just touched on the fact that different parts of Australia are on different cycles. Sydney market strong, Perth market very weak, for example. You don't want to own all your properties in one market, which at one given point in time might be very weak. If you're geographically diversified, you're going to have a much more balanced portfolio. You also avoid things like land tax, which you're going to have to start paying if you're buying all your properties in one state. But Brisbane, yeah, it's one of the rising markets, as I said earlier, and there's plenty of prospects for capital growth. There's rising sales activity pretty much right across the Brisbane metropolitan area at the moment, and there's a whole range of price ranges, lots of different categories of markets you can get into, but the commonality they have is that they're all rising in terms of sales volumes, and there's prospects there for capital growth in a market where prices are, well, you know, in terms of median prices, almost half those of Sydney in some cases. So really good buying proposition at the moment, I think.
That's a really good point you make about the price point. I mean, with Sydney's median house price is over $1 million, and that's for a very good reason, but Brisbane's median house price just over the 500. So essentially you can buy 2 houses for the price of one in Brisbane. However, the caveat to that is I don't think the Brisbane market's going to go as gangbusters as what Sydney has gone. It's certainly going to be strong and positive, but don't expect to see boom style conditions, I think, because of the rate of population growth and other factors driving that market. For Ahmed, the other question about how to buy interstate, well, Ahmed, obviously a big plug for our services is use a buyer's agent. You know, we're on the ground there, we've got the ability to source opportunities for you, and getting someone who can do that due diligence for you is a really important step and safeguards your investment. And you'll actually end up getting it for a better price than I believe than doing it on your own. We have another question here from Meredith, and she asks, I've been looking at off-plan apartments. Do you think apartments or houses are a better investment? Well, as I just mentioned before, Meredith, I think that off-plan apartments you need to be very, very selective. Obviously buying brand new, you are paying a developer's margin, and a lot of apartments and houses depreciate at quite a rapid rate. But having said that, there are exceptions to that rule, like the one I just mentioned before. If you can find a developer that needs to meet a pre-sale requirement to get his finance approved, then he will actually possibly discount the prices in order to get a number of critical sales on board. And then what we see is once they've sold anywhere above 50% of their stock, they tend to increase the price for the remaining sales. So if you can get in the right opportunity, the right area, the right finishes, the right floor plans, but primarily the right location is the number one thing, then yes, you can look at that as an opportunity. Second part of the question, houses or apartments better? It depends. It totally depends on location. If you have an apartment that's close to a waterway or with a harbour view or a beach view versus an apartment that's in an area that has an abundance of land nearby for redevelopment, then obviously it'll do better. So you can't say that one is better than the other. It comes down to the individual characteristics of the suburb, the supply and demand of houses and apartments in that suburb, and the median prices that are driving it. Any other thoughts from you, Terry, on houses v apartments?
Yeah, I mean, I agree with you that it depends on the individual's criteria and circumstances as to which, generally speaking, is the best. In terms of buying off the plan apartments, I just urge people to be very, very cautious, particularly in the inner city markets of some of our major cities. There's no doubt at all that some of our major cities already have or are going to have substantial surpluses, oversupplies of apartments. I mean, you just need to look at the building approval figures. Normally, the breakdown of building approvals is about 70% houses across Australia, 30% apartments. Right now it's 50-50 because there's been a massive number of approvals by developers for new apartment complexes, most of them in the high-rise market, say inner city Melbourne, inner city Brisbane. You've got to be very, very careful about getting into those markets because they're just heading towards some major oversupply. The Gold Coast is another one. And I'd also say to people, don't believe the advertising which says 50 sold out the first weekend or 95% sold out, hurry to get the last few that are available. There's some independent research done recently which shows that most of those claims are actually false and the sales rates are much lower, so don't be enticed by that type of advertising.
No, good point, Terry. Another question here from Nirab, and Nirab asks, how much does a buyer's agent charge for their services? Yeah, great question, Nirab. Look, we charge a fixed fee for our services. We don't work on a percentage basis. So to give you an example, we charge a flat fee of $9,000 for any property under 500 grand, and then above that 500k figure, we have a scale of fees. Be very happy to email that to you at the completion of the webinar. But I guess the next question is, what's the value for money in that fee? Well, firstly, we open up a lot more doors for you to find properties that fit your brief. But I think the number one value we bring to the transaction is helping you identify, firstly, the area and then the property that's going to stack up for you long term. For example, if you bought a property straight off the net and it grows at 4% a year versus using a buyer's agent that helps you find a property that grows at 6 or 7% or more a year, you know, the fee becomes insignificant within 1 year. So getting the right advice and learning to pay for it, it's something I had to do. I went through a number of advisors to try and find the best team that helped me build my portfolio, and I realised that you get what you pay for at the end of the day. You know, if you don't want to pay for research or you don't want to pay for anyone to help you, then I think good luck to you. But if you really want to accelerate your portfolio and get a really high quality portfolio under your belt, then get the right team of people around you to help you.
Yeah, I'd just add to that, Rich, that one of the best reasons to use a good buyer's agent, and I know you're a good one, is the ability to negotiate a property at a really good price favourable to your client, the buyer. You know, if you're charging a $9,000 fee and you've negotiated a $25,000 reduction on the asking price, you've already given them great value, and
exactly.
they've got their fee back plus interest.
That's right, exactly. And the other point, when we've been obviously buying in Sydney as well, like a rising market, there might be a property on the market for 800 and there's 5 other buyers at it. And look, it's very easy for one of those buyers to come in over the top and offer extra 20 or 30 more. But we're able to actually secure it at today's market, and then by the time it's settled or 2 months down the track, it's risen by a huge amount. So it's a matter of also getting people into a rising market quickly so they can capitalise on that growth as well.
One of the best reasons, Rich, to use a buyer's agent is that it opens up much broader range of possibilities for a person. A lot of people get stuck on the idea, well, I need to buy my own backyard because I know my own local market, or I can actually go and inspect things or keep an eye on the properties that I buy. I can't afford to take the time off to fly to Brisbane or to Melbourne to buy there. But if you use a buyer's agent, those sorts of arguments become obsolete and you can actually have access to a broader range of markets.
Excellent. Yeah, really good point, Terry. One last question before we wrap up tonight from Sally. She asks, is it possible to get a positive cash flow property still? Where should I look? Is capital growth or yield the better strategy? Well, Sally, first part of that question, yes, it is still possible to get positive cash flow property. Typically, you need to create the cash flow to be positive. So by renovating, adding a granny flat, building something with dual income, that's the way you can create the additional cash flow to make it positive. As to where to look, well, we've covered off a lot of those areas already tonight, and there's several areas there that will be suitable. And the third part is capital growth or yield the better strategy. Well, that comes down to your individual situation, and I guess that's where you need to have a chat with myself or an advisor to help you work that out. I think both are great, and it's possible to get both. If you're in the early stages of your investing career and you've got a decent income and you're paying tax in your job, then going for capital growth is going to accelerate your ability to recycle the equity and get more properties. If you're on an average income or a lower income and you possibly might lose your job or your job's insecure, then positive cash flow properties are definitely the way to go because it's much safer for you. Like, if you were to lose your job or have some interruption to your income, positive cash flow properties look after themselves. You know, you can buy, in theory, an unlimited number, depending on what the banks will lend you. Whereas with negative yield or properties that require you to put money in every week, you've got to have that cash flow spare to prop up your strategy. So any thoughts, Terry, on that question?
Yeah, I think the key response there is that you don't have to make a choice between capital growth and yield. I think if you buy well in the right places, you can have both. And I think it's a bit of a fallacy that you have to make that choice because you can buy both. There are parts of capital city markets where you can achieve both, but particularly in regional Australia, there are lots of choices in regional Australia, good strong regional centres where you can easily get houses above 6% rental returns and units better. Cairns is an example where it's quite common for rental returns in the apartment market to be 7 or 8%, probably the best you can get anywhere in Australia. So you can get those sorts of rental returns in areas that have got all the drivers for good capital growth and more affordable prices than buying in those sort of inner city, capital city markets. So you don't have to make that choice. And yes, it's certainly very, very, very possible to get positive cash flow property at the moment, particularly with interest rates at the low levels that they are, and they still are at very low levels, even though some of the major banks have had small increases in their mortgage rates.
That's it.
We're going to have a couple of percentage point rises in interest rates before it becomes difficult to find positive cash flow property.
That's right.
At current pricing levels and current interest rate levels.
Excellent. Look, I'm very sorry, folks, but we're going to have to wrap up. I know there's a bunch more questions there you've asked. I'm very sorry we can't get to them, but look, please contact us on our phone number 1300 655 615 or email us at info@propertybuyer.com.au. Or you can just type your question in there and we may get to that later on. I just encourage you, if you'd like to speak with us or take advantage of having a strategy chat with me, there are still a limited number of spaces available. Just jot your details and we'll get in contact with you and set up a time for that strategy chat. But Terry, just like to take a moment and say thank you very much for participating tonight for our inaugural webinar. I really appreciate your insights and knowledge, and we look forward to doing that again. And thank you everyone for listening tonight, and we'd love to hear from you, and all the best for your investing down the track. Thanks very much.